Welcome to the deep dive. Today we're going to be looking at a cross-section of sources, really trying to identify the big shifts that are hitting everything from the economy to corporate power.
Exactly. Our goal here is to just distill what's happening into plain language. We want you to see who's gaining, who's losing, and why any of this actually matters right now.
So let's start with a quick market check. We've got the DJIA up about 1.05%, the 10-year Treasury sitting at 4.194%, and oil's pretty steady at $57.44. But the really interesting story, I think, is this very old-school bullish signal we're seeing. I'm talking about Dow Theory.
Right. And for anyone who doesn't follow it, the theory basically says that you only have a genuinely strong economy when the industrial average is confirmed by the transportation average.
Meaning the people making stuff and the people moving stuff have to be in sync.
Exactly. And that transportation index is up 10% this year. It's actually getting close to a record high.
Okay, so let's unpack that. If transport is rallying, what does that practically tell us? I mean, beyond all the hype around tech stocks.
It confirms that real physical goods are being moved and that people are traveling. You see companies like Avis Budget Group are up, 63%?
Wow.
And Uber reported a 22% jump in trips. It just suggests the economy is performing a lot better than many of the bears thought.
And at the same time, we're seeing these policy shifts that are really helping out the financial sector.
Yeah, the Fed's rate cut got the headlines down to that 3.5 to 3.75% range.
But the bigger move, maybe the quieter one, was the decision to expand its balance sheet. They're buying $40 billion in short-term treasuries.
Right, and that's the crucial part for the banks. It adds liquidity, but it specifically helps regional lenders think KeyCorp, Zions, Comerica. It just eases the pressure on them to keep hiking deposit rates to compete with government bonds.
But hold on, isn't that kind of a quiet bailout? I mean, for regional lenders that maybe didn't manage their deposits well earlier this year, it seems to contradict the Fed's whole anti-inflation stance.
Critics are definitely saying that. They see it as easing conditions for one specific sector, but all this optimism is running up against a big wall.
Which is?
Consumer sentiment. It's still hovering near historic lows. People are just worried about high prices and all the uncertainty around trade policy.
And that's where the legal risk comes in. This looming Supreme Court decision on President Trump's tariffs, the ones imposed under the IEPA.
Yes, the International Emergency Economic Powers Act. If the court rules against those tariffs, the president himself has warned it would be a huge shock to the system, politically and economically.
Okay, so speaking of huge shocks, let's pivot to the AI economy, because the capital flow there is just staggering.
It really is. We're seeing SpaceX finally take real steps toward its IPO. They're scheduling initial pitches with Wall Street bankers this week.
The so-called bake-off, right?
That's it. They're competing to see who gets to lead the deal. And in the talent war, OpenAI is completely changing the game.
By getting rid of the 6-month equity vesting cliff for new hires?
Yeah, which means new hires start owning their stock on day one. They don't have to wait half a year and risk losing it all if they leave. It's a massive lure.
And the compensation packages are they're mind-boggling. Over $100 million in some cases, just to keep top researchers from jumping ship.
It shows you how existential this fight for talent is, and it's breaking old business models.
Especially the billable hour.
Yeah.
In law, consulting.
It's becoming obsolete. Totally. When an AI can review thousands of contracts in just a few minutes, how can you possibly charge based on time spent? It's just not tenable.
So everything is moving toward value-based pricing.
Exactly. The fee is tied to the result, to the efficiency you deliver, not the hours you clock. It's a seismic shift.
And we're also seeing the state step in to rewrite the rules of corporate governance itself.
You're talking about the Trump administration's executive order targeting the proxy advisory firms.
Well, ask Lewis. Institutional shareholder services, the big ones.
Right. And this is, at its core, a deregulatory move. The goal is to, let's say, liberate companies from the influence these firms have over things like ESG resolutions.
So corporate leadership can focus more purely on maximizing shareholder returns.
That's the idea.
So on one hand, we have the market confirming these century-old economic theories like the transportation rally. But on the other, we're grappling with these completely revolutionary disruptions from tech and politics.
I think the biggest collision is between the old way of measuring value, which was time, the billable hour, and the new measure of value, which is pure efficiency, unlocked by AI. The market is very aggressively trying to figure out what the human part is worth.
So that's the final thought for you to consider. What essential human skills, we're talking creativity, judgment, real connection, will capital markets ultimately decide are worth more than any automated hour?